Welcome to Thoughts on the Market. I'm Andrew Sheets, head of corporate credit research at Morgan Stanley. Today, a Fed that looks willing to let the economy run hot, and why this could help the case for credit overseas. It's Friday, September 19th at 2 p.m. in London. Earlier this week, the Federal Reserve lowered its target rate by 0.25% and signaled more cuts are on the way. Yet as my colleagues Michael Gapin and Matt Hornback discussed on this program yesterday, this story is far from straightforward. The Fed is lowering interest rates to support the economy despite currently low unemployment and elevated inflation. The justification for this, in the Fed's view, is a risk that the job market may be set to weaken going forward. And so it's better to err on the side of providing more support now, even if that support raises the chances that inflation could stay somewhat higher for somewhat longer. Indeed, the Fed's own economic projections bear out this willingness to err on the side of letting the economy run a bit hot. Relative to where they were previously, the Fed's latest assessment sees future economic growth higher, inflation higher, and unemployment lower. And yet, in spite of all this, they also see themselves lowering interest rates faster. If the labor market is really set to weaken, and soon, the Fed's shift to provide more near-term support is going to be more than justified. But if growth holds up, well, just think of the backdrop. At present, we have bank loan growth accelerating, inflation that's elevated, government borrowing that's large, stock valuations near 30-year highs, and credit spreads near 30-year lows. And now the Fed's going to lower interest rates in quick succession? That seems like a recipe for things to heat up pretty quickly. It's also notable that the Fed's strategy is not necessarily shared by its cross-Atlantic peers. Both the United Kingdom and the euro area also face slowing labor markets and above-target inflation. But their central banks are proceeding a lot more cautiously and are keeping rates on hold, at least for the time being. A Fed that's more tolerant of inflation is bad for the US dollar, in our view, and my colleagues expect it to weaken substantially against the euro, the pound, and the yen over the next 12 months. And for credit, an asset that likes moderation, a US economy increasingly poised between scenarios that look either too hot or too cold is problematic. So just maybe we can put the two together. What if a U.S. investor simply buys a European bond? The European market would seem less inclined to these greater risks of conditions being too hot or too cold. It gives exposure to currencies backed by central banks that are proceeding more cautiously when faced with inflation. With roughly 3% yields on European investment-grade bonds and Morgan Stanley's forecast that the euro will rise about 7% versus the dollar over the next year, this seemingly sleeping market has a chance to produce dollar-equivalent returns of close to 10%. For U.S. investors, just make sure to keep the currency exposure unhedged. Thank you, as always, for listening. If you find Thoughts on the Market useful, let us know by leaving a review wherever you listen, and also tell a friend or colleague about us today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.